Hi, I'm Joel Perry, the MLO underwriter with Nexa Mortgage. Today, we're continuing our income series by breaking down the different types of self-employed income and how underwriters analyze them. Let me put on my underwriting hat and let's get started. Let's start with the Schedule C. This is the form used for sole proprietor. It's where you'll see anything from a side hustle to a full-time independent gig and sometimes even a multi-million-dollar operation. But generally, once a business reaches a certain scale, it's more advantageous for tax purposes to switch to a different structure. I'm not here, nor am I legally allowed to give tax advice, but I am here to help make sure we maximize your income for your next mortgage. We usually begin with the net taxable income. That's the number that most underwriters are required to start with. But there are two specific lines that still need to be deducted. First is the other income on line 6, and second is meals and entertainment on line 24B. Now, there is a rare exception to the other income deduction. If it's documentable and reoccurring income, like an example I've seen is gas station royalty, it can be counted. But 9.8 times out of 10, it's subtracted from the income. The meals and entertainment line is deducted again, even though it's already included in an expense. Why do we do that? Because the IRS laws say only half of this expense can be written off. The mortgage guidelines know that there's another half and require us to remove the full amount from the income. On the flip side of this, there are things we get to add back to the income. The most common are depreciation and depletion. You'll see this almost every time. Also, mileage for business use and business use of home. These are typically showed on page 2 of the Schedule C, and the mileage deduction should also be reflected on line 9 of page 1, and the use of home is on the bottom of page 1 as well. Last, we look for amortization or casualty loss on page 2. These are a little less common, but still applicable. That covers the basics for a Schedule C borrower. So next, we're going to talk about K1. First, do you own more than 25% of the business? If you do, we always need the full business tax returns, either the 1120S or the 1065s, no exception. Once you cross that 25% ownership threshold, the guidelines require us to assess the financial stability of the business, and without those returns, we cannot do it. If you own less than 25%, it gets more flexible, but a little bit of a gray area. In many cases, we can qualify using just 2 years of the K1s. If the income is reoccurring and distributions support it, that means we'll take your ordinary income and look at line 16, the distribution. And if you're receiving the income, we can average it over that year. If you made $16,000 in ordinary income, but only took $15,000 in distributions, we're going to use distributions and divide that by 12. We repeat for both years and we use the average unless it's declining, a topic for another day. But here's the key point. Regardless of ownership percentage, if the income isn't being distributed, we must verify liquidity. That normally means reviewing the Schedule L for the full business returns to ensure the business has sufficient assets. However, if you own less than 25%, you might not have access to those returns. In that case, we can use alternative documentation, like a CPA prepared balance sheet or a signed CPA letter confirming adequate business liquidity to support the income. So the rule of thumb is over 25% ownership, full returns required. Under 25%, K1s are sufficient if we can document distribution. If not, we've got to prove that liquidity one way or another. Liquidity meaning that you have the ability to make those distributions. Now let's move on to the other two common structures, the S corporation and the partnership, filed as 1120s and 1065s respectively. This is where you see your K1s. These show up on Schedule E of the tax returns. The income or loss should match what's reported as your ordinary income on the K1. Officer compensation is usually in line with your W-2 and it shows on page 1 of the business returns. If you're the sole owner, the W-2 and the officer's comp should align. The rest of the income calc follows a similar process to the Schedule C. We start with a net. We add back what's allowed, we deduct other income, and we have a couple other deductions. One specific thing I want to call out is the mortgage notes payable in less than 1 year. This is not on the Schedule C, but you do find it here, and it shows on your Schedule L in 1065s or 1120s. If there's a number in that line at year end, we typically deduct it from income. Unless documentation shows it's a revolving or reoccurring expense, this is something that's common that CPAs do. So don't panic if you see it, but you will need backup docs if you want to exclude it. The last business type is a full C corporation, filed on Form 1120. These are typically large, complex businesses. If the owner owns this type of business, we're going to rely on their W-2 income and a current pay stub. We cannot use any business profits to qualify unless there's specific documentation showing that the borrower has the right and the ability to access those funds. Most of the time, it's W-2 only. So if you're self-employed or you work with clients who are self-employed, this stuff matters. Give me a call. I'll walk through your returns. I'll calculate your income. Ask your questions in the comments below so others can learn, and let's make today worth remembering.